Welcome back, and I hope you all had an opportunity to enjoy the networking and made sure obviously to visit the exhibition booths and meet with our sponsor partners. Moving on to this afternoon's lineup, it gives me great pleasure to introduce the stage our afternoon keynote. Ms. Elizabeth Wong is the Director of Licensing and Head of the Fintech Unit at the Securities and Futures Commission in Hong Kong. Welcome. I'll now pass to you for your presentation. Thank you kindly for joining us today.
Thank you, Nick. Good afternoon, ladies and gentlemen. It is my pleasure to be here at today's event. Today, I'll be talking about the SFC's regulatory approach and latest work on cryptocurrencies, or as we call them, virtual assets. But before I start, I wish to give some flavor of the challenges that financial regulators are faced with in regulating this nascent asset class and the issues that regulators are focused on. As we head full speed into 2022, cryptocurrencies continue to dominate headlines of the world. According to unofficial statistics, the market capitalization of cryptocurrencies has reached $2 trillion, with more than 17,000 tokens circulating in the market. In the crypto universe, tokens are classified into broad categories, such as asset-backed or unbacked, stablecoins, tokenized securities, utility tokens, DeFi tokens, and non-fungible tokens or NFTs, which have overwhelmingly captured the world's attention due to their record sales. These classifications, however, may not be meaningful, as the distinction between each category is not very clear. Indeed, a particular token type may share features that are present in other token types. For example, utility tokens and tokenized securities may, at the same time, be DeFi tokens. Asset-backed tokens may also be a type of stablecoins. Because of this, regulating crypto activities has always been a challenging issue for regulators from both legal and policy standpoints. This is particularly so given their unique characteristics. First, they are shape-shifting. A utility token today may become a security token tomorrow simply by switching a few features. A few years ago, we were all focusing on how to deal with ICOs. Fast forward to today, NFT is the new hype. Although the space may move too fast to be pinned down by a bespoke legal framework, does it mean that regulators should only take a wait-and-see approach? Further, virtual assets and related activities are borderless. While this may not be a new problem, as cross-border issues also arise as a result of digitalization of traditional financial services, the nature of virtual assets has inevitably made enforcement actions particularly difficult. It is not uncommon for operators to purposely structure their business in a way to circumvent the scrutiny of any regulator. Without global coordination, perpetrators will continue to take advantage of the regulatory arbitrage at the expense of consumers. Another feature of virtual assets is that they are trustless. Traditional finance is organized around centralized institutions. Virtual assets and decentralized finance are, however, run mostly over smart contracts, with no apparent person in charge. These activities do not fit neatly into the existing regulatory regime governing conventional financial markets, as there is no easy place or centralized institution to attach a regulatory hook. Globally, financial regulators and central banks have become more concerned over issues arising from crypto activities. Not only do they give rise to money laundering, fraud, and investor protection issues, but there are also wider implications on financial and monetary stability as the landscape continues to evolve and expand. Recently, the Financial Stability Board also recognized in its report that the virtual asset market could well reach a point of threatening global financial stability due to its scale, structural vulnerabilities, and increasing interconnectedness with the traditional financial system. There seems to be an emerging international consensus amongst central banks and financial regulators that a wait-and-see approach may no longer be viable. Regulation is warranted, with an overarching regulatory principle of same business, same risk, same rules. This brings me to the regulatory approach taken by the SFC on virtual assets. The SFC was in fact one of the first leading regulators to introduce a comprehensive framework for virtual asset activities back in 2018. At that time, we were fully aware that we could have maintained the status quo, and continue to rely on investor education. But doing so would have, in reality, left investors unprotected while virtual asset activities continue to grow. We therefore decided to step in as much as we could to bring activities interfacing with members of the public into our regulatory net. As a forerunner, we set out detailed standards in 2018 for asset managers to manage virtual asset funds. We also provided specific guidance for intermediaries to distribute virtual asset funds. The SFC has also creatively stretched its jurisdiction to the maximum extent in order to apply its existing powers. In 2018, we introduced a conceptual framework for centralized virtual asset exchanges. We proposed that exchanges which are interested in getting our license should offer to trade at least one security token on their platform. This way, their activities would fall within the regulatory remit of the SFC. The standards and requirements under the regime draw heavily on our existing requirements, which apply to securities brokers and automated trading venues, based on our same business, same risk, same rules approach to regulation of virtual asset activities. The framework was welcomed by the industry, as we have provided a clear compliance pathway for operators which are committed to adhering to the SFC's high standards and would like to obtain our license. 3 years have passed since the launch of the framework. Since then, the virtual asset landscape has evolved significantly and is edging into mainstream finance. This is exactly why we recently conducted a review of our regulatory regime to see if any modifications were required. Such review resulted in the issuance of the recent joint circular by the Hong Kong Monetary Authority and ourselves. The circular essentially gives green light to intermediaries to engage in certain virtual asset activities. At the same time, it provides specific guidance and requirements on what they are expected to do when conducting such activities. I would like to take this opportunity to highlight 2 of the key sections in the circular. The first one relates to virtual asset dealing services. We clarified that intermediaries may now buy or sell virtual assets for their clients under an omnibus account arrangement. However, there are some prerequisites which they must satisfy. They should only offer these services to their existing clients that are professional investors. Further, they must partner only with an SFC-licensed virtual asset exchange to trade virtual assets for their clients. As the global regulatory landscape for virtual assets is very uneven, the SFC is concerned that many overseas virtual asset exchanges are unregulated or only regulated for anti-money laundering purposes. These exchanges, therefore, may not be subject to the same robust standards which apply to our licensed exchanges. To prevent investors from being exposed to undue risk, we consider that such restrictions are appropriate and necessary. Intermediaries should also be prepared to be subject to a set of terms and conditions which are tailored for virtual asset trading activities. These terms and conditions align with the standards we impose on SFC-licensed virtual asset exchanges. They cover risk areas associated with dealing activities such as financial soundness, knowledge assessment, prevention of market manipulation, and conflicts of interest. The other section of the circular is on the distribution of virtual asset-related products. Over the past year, we noticed a marked increase in the types and numbers of investment products around the globe available to investors and providing exposure to virtual assets. Some of them are even approved or authorized for offering to retail investors. The SFC generally considers that virtual asset-related products are very likely complex products, as their terms, features, and risks may not be reasonably likely to be understood by a retail investor. When intermediaries offer these products to investors, the requirements which govern the sale of complex products will apply. However, the complex product regime alone may not be sufficient to tackle the unique risks posed by investment products which directly invest in virtual assets. Some examples are ETFs or ETPs directly investing in Bitcoin. Most of the spot markets for these virtual assets are not regulated from an investor protection perspective. Issues such as lack of price transparency or potential market manipulation are not unheard of. Additional counterparty risks may also exist in these products, as service providers in virtual assets may not necessarily be regulated like those in the conventional financial markets. This is why, in addition to the complex product requirements, we have imposed 2 additional measures to the selling of these products. Firstly, in line with our overarching professional investor-only restriction imposed on virtual asset activities, most virtual asset-related products should only be offered to professional investors. Secondly, intermediaries should conduct a virtual asset knowledge test with the client before executing any transaction. If the client has no such knowledge, intermediaries should provide them with training. The position is, however, different when it comes to a limited suite of derivative products like Bitcoin futures or Bitcoin futures ETFs. For this category of products, they are traded on specified exchanges, and in the case of futures-based ETFs, they are also authorized for offering to retail investors in a designated jurisdiction. The distinction is that virtual asset futures contracts, which are traded on a regulated futures market, will typically be governed by conventional rules. The investor protection issues that commonly exist in the crypto spot markets are less of a concern there. The same could be said of a Bitcoin futures-based ETF authorized for retail offering in a designated jurisdiction. Accordingly, we find it acceptable to not impose the professional investor-only restriction for these products. Nonetheless, intermediaries should still conduct the virtual asset knowledge test for its clients before distribution of these products. Existing requirements for derivative products will also continue to apply. We have also clarified the manner in which we expect intermediaries to conduct other types of financial services in virtual assets. These include acting as an introducing agent, providing advisory services, and providing discretionary account management. Details of our guidance can be found in the circular. All in all, the regulatory framework introduced by the SFC aims to capture all facets of public interfacing with virtual assets via mainstream finance for investor protection as well as prudential risk to financial institutions. So far, the responses we have received on the circular are quite positive. We are also currently working with the government closely on the bill to amend the Anti-Money Laundering Ordinance to implement the new licensing regime for virtual asset exchanges trading non-security tokens. Upon enactment of the bill, the SFC will be the regulator of all centralized virtual asset exchanges in Hong Kong. The latest developments and regulatory focus in the international arena have confirmed our earlier decision to step into the crypto space. Whilst we may not have solutions for all the issues arising from virtual assets today, the SFC will continue to work closely at a local and international level to explore a holistic and integrated regulatory approach for the virtual asset space. We hope that the measures taken by the SFC will facilitate the orderly and healthy development of the virtual asset space and provide investors with better protection. Thanks again for having me, and please enjoy the rest of the summit today.
Very informative, and I'm sure our audience will be grateful for hearing an update from the SFC in Hong Kong on regulating virtual assets. Ms. Wong, thank you very much for your time today, and look forward to seeing you at an upcoming event of ours soon.